Welcome to our deep dive on how non-qualified deferred compensation, or NQDC, really affects mortgage qualification. Today we'll unpack why your pay stub, not your headline salary, can make or break your approval, and we'll give you practical steps to avoid surprises. Let's get started. First, we will outline the myth versus the reality. Next, we will explain how underwriters view NQDC in qualification. Then, we will compare NQDC to standard 401k treatment. After that, we will cover the documents you need, strategies and timing, and a case study walkthrough. Finally, we will test your knowledge with a couple of quizzes and close with an important disclaimer and next steps. Let's begin by tackling the most common misconception. Many borrowers believe that lenders will use their pre-deferral gross income, similar to how some retirement contributions are treated. However, that assumption can be a major mistake. This misunderstanding often leads to declined loans or much smaller loan sizes than expected. Now, let's clarify how underwriters really view income. They are focused on stable, qualifying monthly income that is available to service the debt. Large NQDC deferrals directly reduce the income shown on your current pay stubs and W-2s. Unlike many standard retirement contributions that may be added back, material NQDC deferrals typically signal to underwriters that this portion of income is not available to you now. If the deferrals are sizable or mandatory under your plan, regulatory guidelines may require the underwriter to exclude those amounts from qualifying income and instead rely on your reduced, adjusted pay stream. The consequence is a lower qualifying income, which worsens your debt-to-income ratio and can reduce the size of the mortgage you qualify for. This flowchart explains the underwriting path. We begin with the applicant's gross compensation and immediately check for an NQDC plan. If a plan exists, the underwriter evaluates whether the deferral is voluntary and small or large and mandatory. For smaller, voluntary deferrals, the underwriter typically focuses on current pay stub income and may consider limited adjustments if guidelines permit. For large or mandatory deferrals, the underwriter is likely to exclude the deferred portion entirely from qualifying income. After that, the underwriter calculates qualifying monthly income, computes the debt-to-income ratio, and compares it to the program's maximum threshold, leading to either an approval or a reduced loan amount. Let's compare NQDC and 401k contributions. With NQDC, your compensation is deferred and not available immediately, which often leads underwriters to exclude deferred amounts from qualifying income, especially when deferrals are large or mandatory. NQDC also carries employer-related plan risk and requires more complex documentation, prompting stricter scrutiny. By contrast, 401k contributions are generally smaller, tax-advantaged, and individually owned. Underwriters may allow certain add-backs or not penalize them as heavily, and the documentation is simpler. Here is the documentation checklist and why each item matters. Recent pay stubs verify your actual current income after deferral. W-2s for the last 2 years validate historical earnings and the effect of deferrals over time. The NQDC plan document is essential because it details whether deferrals are mandatory or voluntary and whether the funds are accessible. Deferral election forms quantify the current year deferral and help underwriters understand the magnitude. An employer compensation letter can clarify base pay, bonus, equity, and the deferral policy, and speak to the stability and likelihood of continuance. Finally, vesting or distribution schedules help demonstrate when the deferred income may become available, which can inform application timing. Now, here are 5 steps to prepare. First, confirm your current year NQDC deferral rate and total dollars. Second, obtain HAR, or compensation letters, that clearly explain how the plan works and your expected pay. Third, assemble the full plan documents, election forms, pay stubs, and W-2s into one package. Fourth, ask a lender to run a pre-underwrite using your adjusted, post-deferral income so you know where you truly stand. Finally, if your debt-to-income ratio is too high, consider adjusting your application timing or deferral level consistent with plan rules before you apply. Let's walk through a simplified case. Consider an executive with $400,000 in total annual compensation who defers 35% into NQDC. If the entire compensation were paid currently, the monthly gross would be about $33,333. However, due to the deferral, The income shown on pay stubs and used for qualification drops to around $21,667 per month. Underwriting, focusing on available qualifying income, will likely use this lower figure. With the same fixed debts, the debt-to-income ratio gets worse, which directly reduces the maximum mortgage amount the borrower can qualify for. Quiz time. Which income number do underwriters prioritize for qualification when NQDC is involved? Option A, pre-deferral gross salary. Option B, current, stable monthly income shown on pay stubs and W-2s. Option C, future NQDC distribution amount. Option D, last year's bonus before deferral. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Underwriters focus on current, stable monthly income that is available to repay the loan, which is typically evidenced on pay stubs and W-2s. Deferred sums are not available today and are usually excluded. Second quiz. What is the smartest first move if you have NQDC and plan to apply for a mortgage? Option A, assume the lender will add back all deferrals. Option B, apply immediately without documents. Option C, provide full plan documents and run a pre-underwrite using adjusted income. Option D, wait for future distributions and ignore current pay. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Providing full plan documentation and running a pre-underwrite using your adjusted post-deferral income helps you and the lender align on what is realistically affordable and prevents last-minute surprises. This timeline illustrates that while compensation is awarded and partially deferred in the same year, the mortgage application relies on the reduced current income. Over the following years, deferrals continue. Even though distributions may start in a future year, those amounts generally do not help with the current underwriting decision because they are not available yet. The key is that underwriting uses current, available income at the time of application. Before we wrap up, a quick disclaimer. This content is educational and does not constitute financial, legal, or tax advice. Your plan details, employer policies, and lender guidelines can vary. Please consult your lender, HR department, and qualified advisors to evaluate your specific situation. Here are the key takeaways. Lenders look to stable, qualifying monthly income as shown on your pay stubs and W-2s. Large or mandatory NQDC deferrals are often excluded from qualifying income. Documentation is critical. Provide full plan documents, election forms, and compensation letters as early as possible. Ask your lender to pre-underwrite using your post-deferral income to avoid surprises. Finally, your timing and deferral levels can materially impact the loan amount you qualify for. As a quick reference, remember that NQDC reduces the income visible to the underwriter. Provide your pay stubs, W-2s, full plan documents, election forms, and an HR compensation letter. Consider the timing of your application relative to deferral elections or upcoming distributions. Always ask for a pre-underwrite using your adjusted income. To conclude, focus on your real qualifying income today rather than your headline salary. Share complete NQDC documents early to streamline underwriting. Run numbers with your adjusted income before shopping, and consider timing or deferral adjustments to optimize your debt-to-income ratio. This approach sets realistic expectations and helps you avoid last-minute surprises. Thanks for watching. If this was helpful, please like, share, and subscribe. In the comments, let us know how your NQDC plan affects your home buying strategy and what questions you want us to tackle next.